Well, g'day everyone, it's Liam Garman here, co-host of the Inside Residential Property Podcast. And today we have a fantastic episode for you. I'm joined here in the studio by two experts who are going to unpack everything you need to know about the global economy. We're not going to leave any stone unturned, whether it's inflation, interest rates, or global instability. But importantly, what this means for building a residential property portfolio. That is coming up in just a moment.
Real stories, expert insights, smarter decisions.
What you're hearing in the media is behind. You're hearing a lot about Rockhampton, Townsville, those markets 24 months ago. And this will lead into the Darwin market. People are purchasing in this market for the rental yields. And I think the uplift in this market is heavily off the basis of buyer's agents. Compared to the Gold Coast, beach lifestyle, it's very attractive for buyers. For rental yields, it's one of the highest for a capital area. It is going to be our third hub for Queensland.
Who would have thought Melbourne would become, I think it's fifth or sixth most expensive now. It's dropped so far down the list.
Population growth is strong in this area. Vacancy rates are going back downwards. Property prices are starting to increase. We're seeing so many people investing. Prices are already growing.
Right.
So it's already a hot market where we look at Melbourne and it's up and coming.
Who would have thought?
Tune in and find out.
Well, g'day everyone, it's Liam Garman here, editor of Smart Property Investment and co-host of the Inside Residential Property Podcast alongside the amazing team from Rethink. And today we have an exceptional episode coming up. I know a lot of our listeners every week, they're asking us that we want more insights into the economy at the moment. And a lot of our listeners are already going to know we're at a bit of an interesting time in the world of interest rates. We've had two already. Probably more on the horizon if you look at the inflation rates. And of course, there is global instability at the moment. I'm not even going to bother looking into the crystal ball and predicting it can all change week on week. And today I'm joined by two amazing guests here in the studio that are also going to unpack top tips for female investors and how some of the different psychological barriers mean that there are additional challenges for women in growing their investment portfolios. And I'm joined here in the studio by Maya Thomas from Rethink. Welcome to the podcast. And Sarah Megginson. Team, fantastic to hear from you both. I can't wait to get all of your amazing insights. Look, for our listeners, I'm going to give you a chance to introduce both of yourselves, starting off with yourself, Maya.
Thank you. Happy to be here. So I am a part of the Rethink acquisition team for residential. Been there for about 3 years now. And in the residential field for about 6 years.
Fantastic. And Sarah, yourself?
I am a property and finance expert. I've been in the media and been a media commentator for the last, say, 5 years, talking about all the latest trends. And I'm very lucky I get access to all the smartest minds in this space, all the best economists and bank CEOs and all of the people that have their finger right on the pulse. So I get to pick their brains and figure out what's going on. And then I really like to be able to make that very easy to understand for the everyday person.
Fantastic. And I think a lot of our listeners will be quite familiar with your name. They would have seen your bylines right across the investing space, but also broking as well. And I'm sure that they're very familiar with your journey. But to start us off, Sarah, what are your thoughts about building wealth in this environment now? What are you observing in the market at the moment?
It's such a great question, and I think that we could answer it at any year and I would have the same answer because I bought my first property 24 years ago. I was 23 years ago, I was 21. And the market then we were just coming into the global financial crisis. So I bought my property and then 3 years later we had the GFC. And interest rates back then were nudging above 8%. I thought my loan might hit 9% or even 10% they were talking about back then. So since then, I've seen every possible iteration of the cash rate going down to almost 0%. It's surging again. We've had, I locked in my rate on my home loans for 1.99% for a few years. When we had that beautiful run, now they're much, much higher. I fell off that cliff that everyone was talking about. So I've experienced all of it. And I think the most important thing for investors to do is to kind of ignore all of it, ignore all the noise and focus on what you can afford. And if property investing is only affordable to you while rates are at this level, then you're not quite in the right position to invest yet because you need to have a decent buffer there to help you deal with whatever's going to come your way. And, for me personally, I bought a property this year off the plan. And when I got my finance approved in January for settlement in June, it looked very different to what it's going to look like now. And part of our risk strategy with our broker then was to make sure that we had a bundle, of money set aside so that if rates went up, we would be able to chip in a bit more cash because our borrowing power is going to change. And unfortunately, it's happened more than I expected. I thought we'd have one rate rise, not two. But 2 rate rises are going to impact our serviceability by the time we settle. That's where it can get really stressful. If we weren't prepared for that, if we didn't have extra offset, money in an offset to access, and if we didn't have extra borrowing capacity, that would be very stressful because an off-the-plan property is you're settling it one way or another. There's no way of getting out of it. So it's those types of lessons I've learnt over the years as an investor, and I've seen people have incredible success, and I've seen them have a lot of stressful situations, and it all comes down to how you manage that risk. That's such a long-winded answer.
No, and look, that was very much in line with my opinions as well, and it's refreshing to see because all you have to do is go on to the daily news, news.com.au or Daily Mail, whatever your poison is. You would think that the world's falling apart, but the very direct reality of it is 4.1% interest rate is where we were kind of this time last year, right? Or a little bit further before we had the 2 interest rate cuts. So we're kind of at par. Now, yes, property prices have gone up. If you did get more leverage in that time, you might be in a slightly harder position financially, but realistically, we were where we were 1.5 years ago. And the way that I look at it is realistically, and it is a little bit coarse, but it is the cost of doing business, which is in the property investing space, like you said, Sarah, realistically, if a 25 basis point change is going to put you in financial distress, you are over leveraged, or you should maybe be delaying your next purchase. Because at the end of the day, if $100, $150 a month is going to put you in such disastrous economic positions, well, then what happens when the aircon breaks for one of your tenants, or the stove goes out, or, imagine there's mold or a major leak and then it's $20,000, $30,000 fix. That's quite a big problem. A 25 basis point change isn't. However, we might be on the precipice of a few more, and I'm not going to be bold enough to predict what comes in the future because it seems like it changes every day. But yourself, Maya, what are some of your clients thinking, people that you're talking to in the real estate industry? What's the pulse on the ground at the moment?
Buy activity is still really strong at the moment. There's a lot of people out there buying. It's more essentials about holding that loan market. The vendors are dropping prices. So it is a prime time for investors to start coming in.
I think a lot of the investor data is still pretty strong as well. Just this week, data came out that borrowing in Victoria's up 21%.
Yep.
Brisbane's still up. Sydney's up 22%, or New South Wales still up 22%. There's still quite a strong investor demand segment there. And if you do have prices dampening, well, that's actually kind of, and I hate to say it because, you might come across wrong, but the time for a bargain, I try and use that word very carefully because you might actually have the opposite effect, which is everyone delays purchasing, which actually we know when we look at the macro economy, if everyone delays purchasing and keeps money, that's where the economies start dying on the vine, right? But this is a time if vendors are willing to come to the table and have better prices, this is a good time to invest. Now, it would be remiss of us for us not to address some of the big headlines. We're not quite on the eve, a few weeks away from the federal budget. Capital gains tax and negative gearing back in the headlines. Sarah, what do you make of it?
Oh my goodness. We need a whole podcast just to talk about
think
this.
So.
I have been in this space for a couple of decades, and every time capital gains tax or negative gearing gets mentioned in a political sense, it becomes almost like political suicide for that particular leader or party, because there has historically been so much attachment to negative gearing in the property industry. And as a landlord myself, I really benefit from negative gearing. But I can see how we need to look at the way we've been doing everything and make sure that it still makes sense to be the way that we do things going forward. We don't have a crystal ball in the next couple of weeks when the federal budget comes out. It will be interesting to see what happens. I do remember back in 2007 when we had a budget and they changed depreciation rules on a dime. Like, it happened overnight. No one was expecting it. I was working in the media at the time, and we found out 3 days before the budget that it was proposed, and it came through so quickly, and it really did shake things up a little bit.
So that was last year of Howard or first year of Rudd?
It was the first year of Rudd.
First year of Rudd,
Yeah, Kevin 07.
Yeah, that's right. Yeah.
But it was, it really, it shook things up a little bit. And I think what happened then was anyone who had owned a property before that date, the date of the budget, I think it was something like May 7th, 2007, you were grandfathered in. So if you owned the property beforehand, you got to retain those depreciation benefits. And then they changed anything bought after that. It had to be brand new to get the maximum depreciation benefits. And so that did impact activity for a little while, as in people who were already investors were holding on to them. They didn't want to sell them, and it drove people towards new properties, and it changed things. I think we might see that type of activity again, where if you already own a property, there's a lot of benefit in retaining it now if we do see a change to negative gearing and capital gains tax, because it's very likely that those changes will be grandfathered in. And grandfathered means that if you own it previous to that time, the new rules don't apply to you. So I'll be interested to see how that actually plays out. I think existing investors might have an incentive to hold on to their properties for even longer, but we will see future activity shift quite a lot. No crystal ball, but I'm so interested as to what people think is going to happen, because it is a time of a lot of change.
And I'm hesitant to make predictions, as we've kind of spoken about before. But I was just dwelling the other day, which was given market instability at the moment, right? Given market instability, it would be potentially an unwise time to do it. It's not the time to spook the market. Now, my opinions are, 50% of properties are positively geared. So at the end of the day, negative gearing changes don't really matter too much there. I think it would be probably quite politically popular, but I think the amount of investors that's going to impact is smaller than what a lot of people realize. CGT, and I think every real estate influencer and every investing influencer has come out and said, basically, everyone's singing from the same hymn sheet, which is, I'm just not going to sell. I'm not going to put excess stock on the market. When this was first floated, I think by the ACTU a couple of months ago, and my wife and I were about to go unconditional, I turned to her. I'm like, should we still be doing this? She's like, yeah, of course we should still be doing this. We'll just hold on to them forever. And I'm like, really wise. Okay, sign on the dotted line. But what it does mean is there will be less stock being put on the market. When you do disincentivize investors from adding to supply, well, then you might have the reduced, the opposite outcome, which is, yes, you might pay more tax, but you're paying more tax on a more profitable asset at the end of the day. Now, Maya, are you seeing some of this come through in the way that investors are shaping their portfolio? Are they thinking the same way we are, or how are people reshaping their strategies?
No, I don't think it's come into effect just of yet. I don't think it's going to have a massive change on buying, essentially. So no, we haven't had that topic come up in the office. Well,
that's probably good. It means people aren't too spooked by it. Now, we touched on it a little bit, but getting into the nuts and bolts of the interest rate cycle, touched on a little bit earlier, especially in terms of people. It's a cost of doing business at the end of the day, and there are multiple ways that you can cut this up, whether it is you go to second, third tier lenders, working on policies there to make sure you can stretch your serviceability, but also does shift your serviceability at the end of the day. Sarah, where do you think we're sitting in the interest rate cycle at the moment? Is there more still to come? Is it too early to say? Are we ever going to go back? Looking at historical averages, are we at the sweet spot? I mean, you did mention before when you bought your house in 2007, you had 7-8% interest rates. So are we at a historical sweet spot anyway?
Yeah, all great questions. And I definitely, as you said before, I will not put a prediction on record because it will almost definitely be wrong. But I think there are so we go back to the March increase, right? At the beginning of March, end of Feb, beginning of March, the markets had a 0% prediction of a rate increase.
Zero.
It was 0%. Wow. And I have the link. I check it almost every day, the ASX market RBA tracker. And within the first week of March, it was at 22%, and I was still feeling pretty confident. And then the inflation data came out and it overnight jumped to 66%. But even by the day of the rate increase, it was only sitting in the late 60s. So it wasn't a sure thing. And the RBA board voted 5-4. So it was down to one vote, one person on the board that pulled this rate hike through. Which shows how volatile it is at the moment, how there isn't certainty in the market. And investors really crave certainty. We want to know what's happening. You know, most of us, there's a huge amounts of money that we're playing with. And when you talk about serviceability before, I think it's actually a really good thing if your serviceability is impacted. I know that sounds wonky, but I always look at the banks and their limitations as being a sense check for me. So if this particular property we bought this year, for instance, bought it off the plan, we are right at the limit of our serviceability. And in talking to our broker, our options were, if interest rates go up, we can try and find another lender who is going to lend us more, or we can kick a bit more cash in. And I said I would prefer that. Yeah. Our bank that we've got has said this is a good limit for you. I don't really want to stress test that any further because I don't want to be in a position where I'm highly leveraged and I'm one rate increase away from really freaking out. So that is something that I've learnt over 20 plus years as an investor. There were times where I was, wanting to, when I was in more acquisition phase, I wanted to borrow as much as I can. Depending on your risk profile, you might be totally comfortable with that, but you got to make sure you've got all those exit strategies. You've got ways to pay for things if it hits the fan.
Well, good self-censoring.
Yes.
So, in terms of like a monetary buffer that you have,
yes.
What do you have a particular figure that you try and adhere to? Do you have a rule of thumb?
Yeah. Well, I have a couple actually. Yeah. So the general rule of thumb is you should have 6 months of living costs. So we've got that.
I feel like after my last settlement, I was down to the days.
Yeah.
I was like, I pushed myself way too hard.
Yeah. And I mean, that we saw with the pandemic, how people were so universally impacted. That is, and you know what? I have a friend in this situation right now who I'd spoken to her a couple of years ago about this and explained how you can pull a bit of money out of your offset, out of your mortgage, put it in your offset and you've got it there for a rainy day. She didn't understand about that. She now did. She had 50 grand in there. I said, it's just, you do not spend it. It's not money that's accessible to you. It's for a rainy day. Then last August, her husband lost his job completely unexpectedly. And that has helped them get 100%. Through until the new job. And he just got a new job this week. So it's taken that long to get the new job. And she said, if we hadn't done that, I don't know where we would be. We would be so stressed. So having that bucket of 6 months of living costs, which depending on where you live is anywhere between probably $25,000 and $50,000. That's really important. And then when you're investing, I think you've got to have 6 months worth of shortfall. So if your investment is a shortfall of, I don't know, it's different for everyone. Say it's $1,500 a month shortfall, then you want to have about $7,500 to $9,000 set aside. So you've got 6 months of runway minimum before things start to get stressful, because that buys you time. That buys you 6 months to figure out what's my next step going to be. And
there are going to be a lot of macroeconomic factors as well that play into this. So while we're looking at uncertainty on the one hand, the Australian economy is changing, and one thing that I've been mulling on quite a lot in terms of it's a bit of a joke when everyone says the war in Iran and what does it mean for Australia's property prices. I never thought I would actually have a headline like that, but it seems to be what everyone's talking about. We already know that we're in record high levels of insolvency for building and construction companies at the exact same time that we are in a quite large supply crunch, right? So we've got record high insolvencies for builders at a time where we need builders, and we're 20-30% behind on our national housing court. We're projecting in terms of the migration figures, and this is where you can actually make quite accurate predictions for the year ahead. Because people apply for visas. You can mathematically work back and have a pretty accurate guess. And we're looking at another 600,000 person year. So while people might be getting cold feet in the property market and some people might be losing their nerve, losing their cool a little bit, well, the fundamental factors remain the same, that there's going to be more people, fewer places, and add 2 or 3 interest rate hikes. It's incredibly capital intensive to build new homes, whether it's a new estate or whether you're building new units. It's incredibly capital intensive big builders have to carry very big debts to get the job done. Add 2 or 3 interest rate increases to that, they're going to slow down. And I would put money on the fact that you will have fewer building completions come through. We've had the HIA, a lot of industry bodies also say it's not necessarily an approvals problem, it's the cost of doing business in terms of actual construction. I do still think that all of this will mean a decently strong year in terms of growth in the residential property market. Now, that's the world according to Liam. But Maya, what are you seeing? What are some of the trends, some of the current market trends that you're seeing in the acquisition space? And is there anything interesting that our listeners should keep an eye out on?
Yeah, so I reckon the market, we still have a supply and demand issue. It's an Australian crisis at the moment. So every state is in a housing crisis, essentially. Population growth is continuing, markets are growing, but I think there's some markets heavily influenced by buyer's agents. And this will lead into the Darwin market. I think people are purchasing in this market for the rental yields. And I think the uplift in this market is heavily off the basis of buyer's agents. On that as well, we heavily see Victoria as a market strong, which we are thoroughly enjoying. Population growth is strong in this area. Vacancy rates are going back downwards. Property prices are starting to increase.
Like, as you're talking about Melbourne, I was thinking, like, are your clients looking more to Melbourne because it's more affordable? Like, who would have thought Melbourne would become, I think it's 5th or 6th most expensive now. It's dropped so far down the list.
It has heavily.
So does that make it more appealing to your buyers?
Yeah, so we look at Melbourne as like a ready market. It's up and coming. Where Brisbane, we're in the market of a hot market. We're seeing so many people investing. Prices are already growing.
Right.
So it's already a hot market where we look at Melbourne and it's up and coming.
Who would have thought?
So Victoria, smart investors should be looking into the Victoria market now. Strong fundamentals there. Where else should they be looking?
One of my favourite suburbs, like LGA, is up on the Sunshine Coast. We hear a lot about Southeast Queensland. We hear a lot about the Gold Coast, Townsville, Rockhampton, doing amazing, those suburbs, but we don't hear much about the Sunshine Coast. Sunshine Coast is putting a lot of transport into that area. We've got the new railway going in, which is attracting migration. Property prices are sitting at a medium of 1 mil. Compared to the Gold Coast, beach lifestyle, it's very attractive for buyers. For rental yields, it's one of the highest for a capital area. It is going to be our third hub for Queensland. So I have a lot of hope in that area.
So SEQ still has breathing room left.
So I've just personally bought a property in the Sunshine Coast and I would recommend any client that has that mill area to be looking up there. Yeah. Obviously, there are some places in there that I wouldn't recommend. You've got high building approval ratios, which defects on the supply and demand, but it's a hot area in my mind.
So we've heard a lot about how different markets, we're expecting some to grow, some to cool off a little bit. What is one thing that a lot of early stage or first time investors, what's something that they often misinterpret about timing the market?
With timing, they're normally waiting for a decrease or an increase in a market. They're waiting for the prices to go down, so then they're saving in their mind, or an increase where they're heading into a strong market. But by then, you've missed the cycle. You've waited too long. You've missed your capital growth, which is heavy for your portfolio. You need to leverage your first property for a portfolio.
And I couldn't agree more. I mean, the crux of it, if you're waiting for a signal, right? If you're sitting there waiting for the big buy sign, especially when totality data's 3 months behind. I mean, that's just, that is the name of the game. If you're already 3 months behind that big buy signal, I can guarantee there have been thousands of transactions in the last 90 to 100 days between that time, especially if a lot of the transactions, if they come in big groups, maybe you're 4 months behind if it's a monthly totality data. But a very important topic which we don't talk about enough, but it's women and investing, and it's something that there are considerable barriers for women, especially in how they approach investing. Sarah, can you give us some insights into this, some of the challenges, some of the hurdles that you might have faced throughout your career or you've seen other people have, and how you've managed to overcome them and negotiate them?
Yes. I mean, this is another topic that I could do a whole podcast on because it's something I'm super passionate about. Personally, I have experienced all of it. You know, I bought my first property when I was 21, which was a long time ago. And back then, being a female investor was even less popular or common than it is today. And there have been, one situation that pops to mind was an issue we had with a particular tenant, and there were a lot of problems going back and forth, and the property manager wasn't handling it right, and I ended up escalating it to the principal because we just weren't getting an outcome. And I wrote him an email saying, this is the situation, we're at XYZ, can you please call me? And he received the email, looked up our file, and called my husband.
Yeah.
And when he called my husband, he said, why are you speaking to me? Why, my wife handles all of this. And he said, I'm going to get our head of property management to get in touch. But he never called me. And that kind of bias still exists, and it's very frustrating. But you can use it to your advantage. And I'm sure you've had this, Maya, where you're young and beautiful, and people might disregard you when you walk in, like they don't think you're a strong negotiator, or they don't think that you know what you're talking about. I have literally had people say to me in meetings before, property related meetings, where they've gone, wow, you actually know what you're talking about. And
They're shocked.
Yeah. And so that kind of bias against women in investing, it's better than it was, but it is still there. And so last year I wrote a report for Finder called the 2025 State of Women's Wealth Report. And it wasn't just investing. We were looking at all of the impacts. I think something that's interesting is the fact that the gender pay gap actually starts in childhood. So we tend to pay little boys more pocket money than little girls. It's on average about $7.50 a week for girls, $10.30 a week for boys. So we can see it starts there, and it carries all the way through life, which makes investing for women even more important. And the data shows that women make really good investors. They're really good generally. I'm obviously speaking in generalizations, but women are very good at assessing risk, and they are perhaps too good at that because it gives them that analysis paralysis. They're worried about making the wrong decision. And I can completely relate to that. As an early investor, that was one of my big things, as Maya was saying before, trying to time the market and what if it all goes wrong? And, I was so held back by my fears. And sometimes you just got to get in and do it. And I've had the experience now of losing a lot of money. I've sold at the absolute worst times. I sold a property for $600,000 just before COVID, and it's now worth 1.5. Oops. That was my bad. I have bought properties that didn't grow in value. I've invested in developments that fell over, and $70,000 deposit just gone. And each one of those moments was very, very painful. But the more you do it, the more resilient you get as an investor, and you understand that just like anything, it's highs and lows. And it comes back, I guess, to our earlier point of you can't over leverage yourself. And if you are going to invest, you're going to have to be comfortable with volatility. And this conversation we're having about, the current economy and how it's volatile, there's never a year where it's not. In fact, sorry, that's a lie. I would say probably from around after the GFC, like maybe 2010 to 2016, there was a brief period of sluggishness where the markets weren't moving at a crazy level, and it wasn't as much of a daily conversation as it is these days. But in general, it's always volatile. There are always changes happening in politics, in policies, in interest rates, in supply and demand, in migration, in building costs, in all of these things. The global political climate impacts us. There are so many things that impact property. So my view, and what I say to people when they're kind of asking for my opinion on property, I'm like, where do you want to be in 20 years? Don't worry about it right now. And I'm sure you have this conversation with your clients a lot. What is it that you're investing in property for? I used to be editor of a property investing magazine, and the amount of investors I would interview, and I would always ask as part of the process, why do you invest? What are you hoping to get from it? And over half of them would say, I'm not really sure. Just seems like a good idea. And that is the riskiest possible way to invest, because then you're completely at the whim of life and you don't have a strategy. Whereas if you're going, for me, I'm 44, by the time I'm 60, I want to have a decent portfolio that I could live off. That's the goal. It doesn't have to be 20 properties or even 10 properties, but I want enough property that I can live and that I maybe have something to give to my kids, because I'm not sure if they'll ever be able to afford a property. But that future goal, it really crystallizes decisions now, because I was the type of investor early on who would squabble over $5,000 and miss out on opportunities because my budget is here, and if it goes, $1,000 over, I'm not doing it. And now you look back, my personal house that I bought, we paid $660,000 for it, and at the time, it was the biggest stretch. Like, we pushed ourselves to our limit to get it. Exactly what I advise people not to do. But we pushed ourselves to get it. And we and ahed. Our budget was $650, and we went that extra, agonized over that extra $10,000. And it's now the latest value is, I think it came back at 1.94. And we've had it 13 years, so it's tripled in 13 years. And I'm like, we were squabbling back then over 10 grand.
Yeah.
Like, when you learn to let those moments go and go, all right, what am I willing to pay now to secure my financial future? It helps really eliminate a lot of those fears, because you're more focused on the outcome than the minutiae of today. But in saying that, I don't want to disregard how important it is to pay attention to those dollars and cents, because you don't want to get in over your head. But if you've got the right team of experts around you, you've got people who know what they're doing, guiding you in the right direction, then you should be able to have a pretty good scaffolding there around what you can do.
I was taking so many notes when you were talking, Sarah, and I think almost, while you might look back and say, why did we squabble over it? I think it's still wise.
Yes.
It's a wise thing. And one thing that worries me, and I'm not sure whether you both agree or disagree with this, but one thing that worries me about property investors nowadays is people looking for a quick sugar rush, or they think that it's a get-rich-quick scheme overnight, which leads to that suboptimal investing, going to some random town that you've never heard of because you saw it on some finfluencer's Instagram reel and you think that it's going to double overnight. I think, it's still wise looking back to not stretch yourself too thin. I mean, imagine the first the 5% deposit scheme holders now that you might have bought into a really suboptimal unit, say where they're, May, talking about before with supply issues. If you bought into an oversupplied area like Parramatta in Western Sydney, where realistically over the last 10 years, you're averaging 0% return a year. Some places there are selling for less than they were bought 10 years ago. And if you did hold that and you do have several interest rate rises that come through and now you're at risk of negative equity, these people have done themselves perhaps, in some areas a disservice. But to your point as well, I just made a note of it, the volatility with the sugar rush aspect, people don't realize that volatility goes up, but it also goes down. You have to expect that. Yes, Melbourne may have dipped a few years ago, but hey, that's when there's going to be the upside afterwards. The third point that I noted, because your amazing insights, Sarah, the kind of latent sexism. Now, it's funny that you gave the example of the property manager. I would show it on screen now, but except you would see all of our details. My wife asked me to speak to one of our property managers about 2 hours ago. She texted me and then she said, you're a boy, they'll probably listen to you, because they're not responding to emails. But that is the day-to-day that people have. Whenever we talk to a broker, and it's almost like, you pivot your seat to talk to the man. And this stuff is still day-to-day. And unless you highlight it, unless you're actively calling this out, it's not going to change unless you actually acknowledge it. Now, that was a lot of verbiage, but it was off the back of a great segment. Maya, what are some of your tips, your hacks, some advice to maybe young women who are looking to invest? It's quite a challenging time. Prices are quite high, about where they can start their investing journey.
I always recommend having a team behind you. Like, education is key in this. You're not going to grow a portfolio just guessing or listening to the media. You need backing, you need data to help where you're going to go. It's a massive one. Education will also relieve the stress of what you're doing. Obviously, investing, you're putting a lot of money away. You can't physically see that in your bank account anymore. It freaks out a lot of women. So I think knowledge is key in this aspect.
I think it freaks out, a lot of people. Suddenly when you thought you were very cash rich, and then it all goes and then
on that deposit.
Yeah, and then a few weeks in, and then suddenly there's works out of nowhere, and you're seeing it dwindle. But you are right. It's the financial literacy aspect is so incredibly important. And turning to that, one thing that we were going to discuss throughout this podcast as well is, raising the next generation in terms of that financial literacy. Sarah, raising rich kids.
Yes.
What does that actually mean? It sounds a little bit controversial, doesn't it?
It really does. I have just written a book called How to Raise Rich Kids, and it comes out next month. And I chose that title because it's a bit provocative, because when I say raising rich kids, I'm not necessarily talking about wealthy kids. I'm talking about raising kids who are rich in opportunity in life. So I've got 3 children. My hopes and dreams for them is that they can have a really adventurous life and they can take opportunities, they can travel, they can try things with a financial safety net, and that they don't feel trapped by their circumstances. So that to me is achieved through financial literacy. So I have, it's been very important with my kids growing up. They have had a wonderful life, but they don't get anything for free. They've been doing chores around the house since they were 5, and we give them pocket money. And even I've got 2 in high school, and when they started high school, they needed, I should say, a laptop for school.
Yeah.
They wanted an Apple. Big price difference between like student laptop and the Apple they wanted. It was about a $900 difference. And so I said to them, this is what you need and this is what you want. I'm prepared to pay for what you need. You can pay for the rest of what you want. And we worked it out. We actually ended up getting it on sale. So it came to $30 a month. And my eldest daughter, we made a contract. She had to pay $30 a month that she earned in pocket money or, making beads, bracelets and whatever. She had to find that money every month. And she paid it off. She paid it off every single month. She never fell behind. And most importantly, that laptop is now going into its 4th year. Yeah. And it is still pristine, because she really has a sense of ownership and pride over the fact that she made that happen. So her younger sister started high school last year, and we did the same thing with her. She's been really good. And even for her birthday last year, she got some cash, and she was like straight away gave me $60. She's like, Mum, here, I'm paid 2 months in advance. Now I can relax. And I love that.
That's cool.
She's having that little bit of stress, because I'm like, that's what the real world is going to be.
Yeah.
And I want you to really understand that you can have so many wonderful things in life, but it's to like this whole conversation, it doesn't come easily. It doesn't come without risk. It doesn't come in a zone of comfort. It comes from doing things that scare you a bit and taking risks and being prepared for less than optimal outcomes. Such a long-winded answer again, but that's what my whole book is about. I've written this book called How to Raise Rich Kids. It's really about how to set your kids up with the right financial literacy. I break it down into the 4 age groups. So under 5, 5 to 10, 10 to 15, 15 to 20. And then there's a deep dive into each type of investing. So whether it's shares, property, ETFs, index funds, whatever it might be. So you can read through all of them and figure out which strategy makes most sense to you and what you would like to do for your kids, and hopefully set them up with a bit of a head start financially, because that when I was young, buying a house was still quite achievable, and these days it's not quite the same situation.
And it's that ties into what a lot of like family offices do in the US and Europe as well, where I never got to experience it, but where you, for teenagers and young adults, where they would have like summer, you would probably know about this, like summer internships with like UBS, but it's not an internship because they go there and it's a structured course where they take people with family offices to teach them how to not lose their money.
Yeah.
And they would take these kids in for 1 or 2 months and just basically make sure that, hey, you've got this huge inheritance coming through. This is how you build it and not lose it over the long term. And that is critically important to make sure that you do value money.
Yeah.
And understand the benefits of investing wisely. Now, Mayo, you would have seen it in the past where relatively young Aussies saved their, probably not pocket money, saved their first job, their grad money, their apprenticeship money, and they've used it pretty wisely.
Yes. A lot of people are putting a lot into super. We're seeing young couples, which is amazing, and shares. I have a lot of my friends using the share market to get a head start to obviously get into the property market, because it's not that achievable anymore to get there.
And any good case studies of people that have grown pretty rapidly?
We had a young couple as a client. They bought a duplex up on Townsville through their super, and that has done amazing. That yield when we bought was about 6%, and that has just grown. They'd be ready to buy again in less than 12 months. Actually, no, that would have been 18 months, that purchase. So obviously, yes, there's a lot of smart investing to be done. It's just getting there. That first step is the hardest part, that money.
Oh, 100%. And then you can take equity. You can do
that
some
first
fun stuff
property
after that.
is the key to your portfolio.
Absolutely.
To
Now,
leverage.
I think we're a little bit stretched for time. I'm going to close it off with some top lessons from Maya and Sarah for investors entering the market in 2025, 2026. Maya, what is your top bit of advice? Probably for young Aussies, but not necessarily just young Aussies. Anyone that's looking to get onto the market now, what should they be doing?
Don't listen to the media. What you're hearing in the media is behind.
Yeah.
You're hearing a lot about Rockhampton, Townsville. Those markets were 24 months ago. Don't listen to what you're seeing out there.
Oh, 100%. And on that, I'll extrapolate that. I'm going to give my advice off the back of that. Don't listen to family at barbecues or family birthdays. You know, we settled on a place in Melbourne a few weeks ago, and the feedback that you get from telling people that you're buying in Victoria is like, why would you do that? And it's like, well, you know, firstly, you don't get an opinion. But secondly, Eddie's wise. Like, as we highlighted before, the economic fundamentals stack up. But there is inherently, there is a lot of herding behavior that goes on in the world of property investing. And you're so right that by the time it's a headline, the investor money's already come in. You know, the totality data's already corrected. Especially by the time, you know, Cotality or Prop Track, when they had their 12-month reports come out, and it's already gone up 30%. Well, you're at the tail end of it by that point. Sarah, what's your top tip for people entering the market?
Yes. Well, I want to piggyback off both of you there and say I fully agree. I remember once sitting on a plane next to a guy who asked, "What do you do?" And at the time I said, "I'm editor of a property investing magazine." He said, "Oh, property investing, rubbish. No, you lose heaps of money that way."
Oh.
And I went, "Oh, okay. Well, I kind of
sure
speak
about
to, you know, dozens of property investors every month who say otherwise."
Yeah.
And I had just sold an apartment and made $100,000 off that apartment. He goes, "No, apartments, you never make money." And I went, "Oh, okay. I guess my actual lived experience doesn't matter."
Yeah.
So to your point, don't talk to anyone about this stuff.
Yeah, definitely. Yeah.
It stirs up a lot for a lot of people. If they themselves, if it's something they want to do and they don't quite have the courage or the situation to do it yet, it can stir up a lot of, you know, feelings for them. If they think they know better and they're trying to stop you from taking a big risk and making a big mistake, they can be trying to save you. So just really be mindful of your audience. And my tip would be, you're going to pay for your education one way or another. So you're either going to pay for it through making a lot of mistakes, which was my particular route, or you're going to pay for it by paying experts to help you. People like Maya, or accountants and property advisors and all of the different people that you can help set you up. And I'll just give a really quick example. I know someone who earns a really decent income, like we're talking, you know, 300,000 to 400,000. So paying top tax dollars, and they bought an investment property that was highly positively geared. And when he bought it, I said, "Why did you buy that one? Because you already make great money. And you've now, that's awesome. This particular place, I think he was making 50 or 60,000 a year off it. So that's fantastic. So you're making 50 grand a year. After tax, you're making 25. You've gone through all of that effort, tied up your capital, paid all those fees to make 25 grand a year. And now I'm not knocking that. That's a huge amount of money. But for him, that doesn't change anything. I said, where are you building your wealth for the future, for when this income stops, for when you're no longer working? Like, why are you not buying a capital growth property that allows you to negatively gear? So, you know, someone like him could have really benefited from having the right team of experts around him. And so I think really think carefully about where you're scrimping and saving and where you're investing your money, because you'll always get a good return out of really good experts, and qualify your experts. You know, read reviews and make sure that you're working with, for instance, genuine buyer's agents, not a developer who is selling particular property and calling themselves a buyer's agent, but actual genuine registered buyer's agents and accountants and advisors and people who can really help you achieve your goals.
Oh, there are some horror stories out there, and some you see it all the time, especially through Instagram, but also when you do get down the funnel and people offering just really bad financial advice at the end of the day. And it is heartbreaking when Aussies, work for years and years and years to scrimp and save to get a deposit, and it is lost. You highlighted some of the stories before, especially in a market like this. It can be real life altering. So couldn't agree more. Make sure you're surrounded by the A team, good VA, good broker, good accountant, and they should take you on that journey. But team, I think that is all we have time for today. Thank you so much for joining me on the podcast.
Such a pleasure. Thank you.
That was Maya Thomas and Sarah Megginson on this episode of Inside Residential Property. Now, if you liked the episode, make sure you send it to all your friends and subscribe to us on YouTube. Give Rethink a follow on Instagram because they have some amazing content helping people grow their residential property portfolio. But that is all we have time for today. We'll be back at the same time next month with another episode. But until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.